Hi everyone, and welcome to ACCAP4 Live Session 2. The objective for the day is to handle Advanced Investment Appraisal 2 and then bit of cost of capital. But as we did last week, we couldn't do the free cash flows. So I am quickly going to go through the free cash flows from chapter number 2 of your lecture note, which starts from page 41 of your lecture note. So if you can pick from page 41 of your lecture note on free cash flows, we quickly do the free cash flows and then we move on to the day's objective. So if you go to page 41 of your lecture note, we're starting with the free cash flows. What is a free cash flow? This topic is really important because you need it for the measures and acquisition is the main challenge, and the measures and acquisition, and we have decided to bring it in chapter 2 so that you have enough time to actually practice on it before we get to measures and acquisition. And as I told you last week, chapter number 2 is a very heavy chapter because there are so many topics that you would have to learn from there. Okay, so let's get back to the free cash flow. What do we mean by the free cash flow? The common name for free cash flow is simply net cash flows, which we all know that. Last week when we calculated the NPV, we started by saying sales, variable cost, specific fixed cost, tax savings on capital allowance, initial investment, working capital. We got the net cash flow. That net cash flow is what is technically called the free cash flow or surplus projected cash flow. Why is it called free cash flow? Because when you trade, you would have to make sales. When you make sales, you have to pay your operating expenses out of it, which is the variable cost and then the specific fixed cost. When you pay the operating expenses out of it, what are you supposed to do next? Whatever money that is left, you have to pay your tax. If you pay your tax, you also have to use some of the money to buy non-current asset, which is your investment. You also need money to run the business on day-to-day basis, which is called working capital. So if I've made money from sales, I've paid my operating expenses, I've used some of the money to buy non-current asset. I've also used some of the money for financing my working capital. Whatever money that is left, what am I supposed to use it for? That money is free, and once that money is free, it's available to be distributed to providers of capital. So when we say free cash flow, it is what you know as the net cash flow. It is the cash flow which is available to be distributed to providers of capital. And who are the providers of capital? Providers of capital are the debt holders and equity holders. So free cash flow is basically the cash flow that is available after you've paid all your expenses, you've paid money for non-current asset, you've also left money for your working capital. Whatever is left should be given to the equity and debt holders. What do we use free cash flows for? We can use free cash flow to do so many things, which the examiner reserves the right to test you on that. The basic one we know is to use free cash flow to calculate NPV, because we said free cash flow is the same as the net cash flow. So when there is a question and the examiner asks you, using the free cash flow methodology, calculate the NPV, nothing has changed. It's like me telling you, using the net cash flows, calculate NPV. So this is what we have been doing from F9 up to what we saw last week. We can also use free cash flow for calculating the value of a company and as such the price. And that is the first one here. And as I was telling you, the major challenge and measures and acquisition is if A is going to buy B, How much should A pay to take over the shares of B? There's the need for us to value B. And the common technique the examiner is using in the examination room is what is the free cash flow approach. We can also use the free cash flow to assess the performance of a company. So all these, we're going to go through them with the exception of the NPV one, because we have already calculated the NPV and everybody should be clear with the NPV. Okay, so now let's see. How do we calculate free cash flow from accounting information? When we were calculating NPV, normally we assume sales, variable cost, specific fixed cost. All of them are in the form of cash because we needed cash flows. However, when they give us the information in the form of income statement and statement of financial position, obviously they are not in the form of cash, because income statement is actually prepared on the basis of the accrual basis. It's not receipt and payment. Okay, image is on page 41 of your lecture note, page 41 of your lecture note. That is where I picked from. Okay, so currently I am on page 42 of your lecture note. Okay, so if income statement and a balance sheet is given to you, it is not prepared on receipt and payment basis as cash flows. Therefore, how will I be able to calculate the cash flows from accounting information? It follows the same principles as you did in your P2 or your F7 and cash flow statement, International Accounting Standard 7. However, if you have forgotten about your International Accounting Standard 7, the good news here is that so far as P4 is concerned, it is a template. And that template is what is given to you in your lecture note. So when they ask you to calculate free cash flow and accounting information is given to you, you are going to follow this format in order to calculate it. First, start with your profit before interest and tax. Start with profit before interest and tax. Then follow by the tax. And remember, the tax should be the profit before interest and tax multiplied by the tax rate. People will appreciate that profit before interest and tax, we have to do interest before we get profit before tax and apply the tax. The interest is part of the cash flows we are referring to as that free cash flow. So when I am calculating the free cash flow, I am not interested in anything in relation to the interest to be paid to debt holders, because we said that free cash flow is the cash flow available to be given to the debt and equity holders, and monies to be given to debt holders include interest. So the free cash flow I am looking for down there include interest, and therefore I should not include the calculation of the free cash flow. I should not include interest. So remember, when you pick profit before interest and tax, your tax should be the tax rate multiplied by your profit before interest and tax. Ignore the interest, because the effect of the interest is part of the free cash flows you are looking for. So the examiner might intentionally tempt you by giving you that interest in the income statement. And some people will say, oh, interest is a tax allowable expense, so let's deduct before we apply the tax. And I'm cautioning you, that is why your lecture note has done this bit for you, that less taxation is simply your profit before interest and tax multiplied by that tax rate. And when you do the tax, the next thing you need to remember is the profit before interest and tax is profit. We needed cash flows, and the profit might be calculated after we've taken care of cash and non-cash items. So any non-cash items like depreciation, capital allowances used in arriving at that particular profit is supposed to be adjusted. So the common one in P4 is obviously depreciation, which sometimes will be represented as capital allowance. So add back your depreciation, add back your non-cash items like depreciation. When you finish, then what you have got as the profit before interest and tax less tax and add the depreciation is you have converted the profit into cash. If I have converted the profit into cash, then what do I need to use to buy non-current asset? The cash I need to use to buy non-current asset is what we are referring to here as the capital expenditure. And then do you also need money to pay for working capital? If your working capital increase, money is gone out, so you would have to deduct. If your working capital decreases, it means you have actually received money. And once you have received money, all what you would have to do is that you need to add back. So you have to deduct increase in working capital, and you have to add decrease in working capital. And that will give you the free cash flow. So when they ask you to calculate free cash flow, your mind shouldn't go anywhere. Let your mind stay on this template. Anything that the examiner give it to you, you put it in there. If there's nothing in there about that particular line, for instance, if he hasn't given me working capital, I can't force myself to put it there. That's it. So this is your template for the calculation of the free cash flow. Let's go straight to the example. HWT PLC has earnings before interest and tax of 225,000 for the current year. Depreciation charges for the year have been 15,000 and working capital has increased by 2,500. The company needs to invest 22,500 to acquire non-current assets. Profit are subject to taxation at 30% per annum. Calculate free cash flow. As long as you have got a template, it is straightforward. I need my profit before interest and tax, which is given to me as this. So that is what we've put there. I will need to deduct tax. You following the template. I will need to deduct tax. Tax, as I said, should be the percentage based on the profit before interest and tax. So it's 30% of the 22,500. That is what 225,000. That is what is giving you the 67,500. Then you have to add non-cash items. Depreciation is given to you as 15,000. Is there any money needed for non-current asset we call capital expenditure? Question said 22,500. Is there any decrease or increase in working capital? This is how you have to lead yourself, because that is your template. So you ask the question, I need decrease or increase in working capital. Have you got it? Question will tell you, I have given it to you. So you said, or I haven't given it to you. Leave it out. This is how you would have to be interacting with the question. So here is telling you there's working capital increase of 2.5. So less that. And this is your free cash flow. Basically that. Next, free cash flows to equity. All what I'm going to tell you about free cash flow here is you would have to get the format on here. The moment you've got the format on the brain, that's it. Okay, you look at the format, you read the question, you do the substitution. Next, free cash flows to equity, dividend capacity. Hold on for the dividend capacity. I will come back. Let me explain the free cash flows to equity. We said free cash flows are those cash flows available to be given to providers of capital by way of debt or equity. Okay, so if I say free cash flows to equity, that cash flow is now available to only equity holders. When I say free cash flow, full stop, it's for both debt and equity holders. When I say free cash flows to equity, it's for only equity holders. So free cash flow to equity is simply the cash flows available to be given to only equity holders. How do we calculate it? That also follows a format or that template. The only thing we would have to adjust here is that as long as I need the free cash flow to equity, I would have to deduct all those cash flows associated with debt. And what will be the cash flows associated with debt? For instance, when you were doing your cash flow statement, you saw financing, operating activities, investing activity, and financing activities. And financing activities, when you go there, you're going to see proceeds from the issuing of debt. You're also going to see payment or repayment of debt. So the only thing that you need to adjust so far as P4 is concerned, they are not expecting you to go and do the whole of your cash flow statement. It's a template you're going to follow. Okay? So far as the P4 is concerned, the only adjustment the examiner is more likely to worry you about will be of the fact that if I'm calculating the free cash flow to equity, I would have to deduct all, or I have to adjust all cash flows associated with debt. And the cash flows associated with debt, the first one that you have to think of is interest. So I will say profit before interest and tax, less interest, okay, less tax. When you do the income statement and you say profit before interest and tax, less interest, less tax, the figure that you will get is what is in the income statement called profit after tax. And we all learn from basic level that profit after tax are the profit available to be given to the ordinary shareholders. Okay, so it's the same as the profit after tax. So in the exam room, don't go and waste time and start from profit before interest and tax. Here we are teaching, so we wanted to tell you that as long as you want free cash flow to equity, interest is supposed to be deducted before you come and get the cash flow that will be given to only equity holders. Then if I get the profit after tax, that profit is obviously not a cash flow. So all the non-cash items which were deducted are supposed to be added back. That is why you see add back your non-cash items like depreciation. The moment I add the non-cash items, I have brought the profit into cash. If I have got the cash, then there is the need for me to pay off my non-current asset I need to buy. So that is your capital expenditure, any money needed for working capital. Then you ask again, is there any proceed from issuing of debt? It's associated with debt. Add to that. Then you also have to less what? Any repayment of debt. So the monies I made from trading, I've used some to pay off my asset, working capital, pay off debt holders, also received money. Whatever money that is left, I don't need it to use it to pay debt, to pay asset, to pay for operations. That money is available to be given to the ordinary shareholders. So once again, it is a template. So let's go to the note. We pick this. Hold on, I'll bring you back to the dividend cover. So when we go to the note, we're going to say, example, okay, the following data relates to MLS Limited. Forecast income statement for the next year, revenue, cost of sale, gross profit, operating expenses, earnings before interest and tax, interest charges, profit before tax, corporation tax, profit after tax. During the year, loan repayment are expected to amount to 69 million, depreciation charges to 30 million, and capital expenditure to 60 million. The dividend payable is 30 million. Calculate the free cash flows to equity, dividend cover based on free cash flow to equity. As I said, hold on, I want to take them one for you. Okay, so if I have to calculate free cash flow from accounting information, I need my profit before interest and tax, less what? Tax, add non-cash items like depreciation, less capital expenditure, add or less increase or decrease in working capital. That's it. So when we come here, I will say this is my profit before interest and tax. So this profit before interest and tax is what we have put here. Then the tax should be based on the profit before interest and tax. Why we did that? Yes, because interest is not a cash flow to be given to equity holders. Interest is cash flow to be given to debt holders. So if I want the free cash flow to equity, I need the cash flow which is only available to be given to equity holders. So that cash flow should be the leftover. After you have paid for your asset, you've paid for your liabilities, expenses, and everything, and you have also paid all monies to be given to debt holders. Whatever is left is what you're supposed to be giving to equity holders. So we need the money that is for only equity holders, not to include debt. And interest is not for equity. Interest is for debt. That's why we are deducting the interest. Okay? So if bringing ourselves back, you will get your profit before interest and tax. The tax should be a percentage based on the profit before interest and tax. Okay, and that is the 313. Okay, so you will deduct. And then is there any non-cash items like depreciation? No working capital is given to me. I can't force myself to bring it. And as such, there's a capital expenditure. It's a template. So make sure you know the template, you read the question, you put those figures in there. Okay, now let's go and calculate the free cash flows to equity. your note has done something brilliantly, okay, in the sense that you have been given two ways of calculating the free cash flow to equity. The format gave us the normal way of we calculating it. But exams is exams, we all know that. So the examiner can give you free cash flows and you might be asked to calculate the free cash flows to equity. Or you might need the free cash flow to equity to do something. And the free cash flow is given to you. Is it possible for you to adjust the free cash flow and bring yourself to the free cash flow to equity? That is one thing. Or alternative approach is the examiner gives you everything and you start calculating from beginning to the end. So your note, we're going to show you all the two situations. So giving me the free cash flows, if you look at the format here, the only changes we have to make between free cash flow and free cash flow to equity is interest and then the cash raised from issuing of debt and repayment of debt. So these are the three things you have to note. So giving me free cash flow, I can make adjustment to that free cash flow to get the free cash flow to equity by deducting the element of interest and adjusting for any proceed from issuing of debt or any repayment of debt. These are the three things you have to note. If they are given, you do them. If they are not given, you move on. Therefore, if I've got free cash flows of the, come here, if I've got the free cash flow of 173.78, then given this free cash flow of 173.78, I can make adjustment to that free cash flow to bring myself to the free cash flows to equity. And how can I do that? I need to remember, is there any interest to be given to debt holders? Because we didn't deduct the interest before we got this. Because we said that 173 is cash flow for both debt and equity. Now I need the one that is only for equity. So interest is supposed to be deducted. However, you need to remember that interest is a tax allowable expense. So by you paying interest, it should save you tax. Got it? Therefore, the adjustment, you don't have to go and deduct the whole interest. You only have to deduct the net interest after tax, because that interest you pay should save you tax. That is why the gross interest, if you look at the question, gross interest is 24, but because tax rate is 35% and interest is a tax allowable expense, then we have to get the net, and the net should be 1 minus the 0.35, and this will give you the net interest. Okay, this will give you the net interest. So the only problem and the adjustment here is how you remember that you are not going to deduct the whole interest, but because interest is a tax allowable expense, you need to take the tax effect out in order to get the net. And then, is there any loan repayment? Is there any proceed from issuing of loans? According to the question, there was only loan repayment, and then you deduct, you come and get the free cash flow to equity. So this is the money available to be given to only equity holders. Alternatively, we can go through the long way. If you go to your format, I told you, it doesn't pay for you to start from profit before interest and tax. It doesn't pay at all to do that, because the sum of profit before interest and tax less interest and less tax is what is called profit after tax. So I picked the profit after tax from the question straight, and that profit after tax is 188.18. So that is what we pick straightforward. So this is your profit after tax. Look at the template. If you pick your profit after tax, it's profit, it's not cash. So you need to bring it to cash by adding the depreciation. That's why they added the depreciation. Then you ask, is there any repayment of debt? Is there any capital expenditure? Is there any working capital requirement? That is what we brought there. And that will also bring you to the same level. So whichever the examiner will do, I believe you should be able to be comfortable. Now let's come to the dividend capacity. Let's come to the dividend capacity. I told you I am going to skip it because I want to handle it one-one. So we know free cash flow to be the cash flows available to be given to only equity holders. When we did F9, we were told that Dividend cover measures the number of times the profit will be able to pay dividend. Number of times profit will be able to cover the dividend. That's why they call it dividend cover. Dividends are paid out of profit, but the medium of payment is cash. Profit is a concept. So if I'm going to pay dividend out of profit, when I'm going to pay the dividend, I would have to pay using cash. The fact that a company has made profit does not mean the company has got cash. No way. Because it could be that your sales all is in the form of receivables. You haven't got the money. So the fact that I have made a profit after tax of 188 here does not mean I am in position to pay dividend of 188. It could be I haven't got the money. Therefore, if I am assessing the ability of the company to pay dividend, that is what is called the dividend capacity. What is the ability of the company to pay dividend? How many times the company has got the capacity to pay dividend? So when the examiner asks you assess the dividend capacity, he is simply asking you to calculate or assess the number of times the company is in position to pay dividend. Okay? Paying dividend out of profit, we use cash as the medium of payment, and as such, profit will not be the best yardstick of assessing the ability of the company paying dividend, because assuming I made profit of 200 and dividend I am paying is 20, it means I can pay 10 times. Meanwhile, all the profit were in the form of receivables. I haven't got any cash. But I tell shareholders, I will pay dividend 10 times. And they say, okay, pay the dividend. Where are you going to get the cash to pay that? Okay, so from this time onwards, forget about F9. From P4 onwards, when they ask you to assess the dividend capacity of the company, you are going to assess it on the basis of the free cash flows to equity. Why that? Because we said the free cash flows to equity is the cash flow to be given to the equity holders. So if I've got free cash flows of 100, that 100 is cash to be given to equity holders. Therefore, if I am paying dividend to them, the monies I can use to pay dividend to them is that 100. And that is the best yardstick for calculating it. So the simple formula is your dividend cover should be calculated as your free cash flows to equity divided by the amount of dividend. That's it. Okay, because if we have used profit, we would have said profit after tax is this divided by 30. We would have said our dividend capacity is going to be 6.3 times. Are you in position to pay 6.3 times? Your profit can pay 6.3 times. But even though you made this profit of 188, the cash you have available to pay to ordinary shareholders is 89. So you will deceive the shareholders that, oh, the company is having 6.3 times capacity to pay dividend. Meanwhile, they are not in position to pay it. Okay, so that is that. What can I say? The examiner has tested this twice. Okay, dividend capacity. It's not coming simple like this. Let me create a scenario for you to appreciate. The whole argument is this. When they ask me to calculate the dividend capacity or assess the dividend capacity, I need the free cash flows to equity divided by the amount of dividend I have to pay, as we've done here. How the examiner will do it is the examiner's imaginations. This is all what you need. And you ask yourself, do I know how to calculate free cash flows to equity, which is the template? What he did the last time was he gave, let's say, 4 or 5 years. I can't quite remember. 4 or 5 years, and you were supposed to assess the dividend capacity over the 5-year period. All what you need to remember is every year you calculate the free cash flow to equity for every year, and then you calculate the dividend they intend to pay every year. When you get that free cash flow to equity each year, you divide by the amount of dividend they want to pay, and then you get the dividend capacity. So don't think it's only 1 year. And by the common sense here is that as long as you be able to do free cash flow to equity for 1 year, you should be able to do it for 10 years. It's the same format. The only difference is that maybe year 1, your free cash flow will be different from year 2 free cash flow by way of amount, but not by way of what you have to put in. So picture the format and try to work through in order to get the free cash flow. Let's go to the next. Valuing a firm using free cash flow method. Valuing a firm using free cash flow method. This is where I am so much concerned because we need for the measures and acquisition. The value of everything, theoretically, the best value of everything is the present value of the cash flows that goes with the thing. So if I want to value a company, the value of the company should be equal to the present value of the future cash flows that goes with it. And we said the free cash flow is the same as the net cash flows. So the value of a company is simply the present value of the future free cash flows. So these are the equations I do for you. Your corporate value, which is the value of the company, is the present value of the future free cash flows. Okay, future free cash flows. So when I find the present value of the future free cash flow, I have to get the value of the company. The question here is, be with me because this is the challenge. The question here is, if I need present value, then I will need a cash flow and I will need a discount factor. What discount factor should I use here? We all said the discount factor every time should be the appropriate. It should be consistent with the cash flows. So if this cash flow is free cash flow, we said this free cash flow is for both equity holders and debt holders. So the discount factor I will need to discount the cash flows should be consistent with that cash flows. So if the cash flow is for equity holders and debt holders, I will also need a cost of capital, which is also for equity and debt holders. And that cost of capital is what we call the WACC. Okay, so for me to calculate the corporate value, I will calculate the free cash flow for every year up to whatever number of years, because we said present value of the future free cash flows up to whatever number of years, and I would have to discount it using WACC. Okay, now, if this free cash flow is for equity holders and debt holders, it means when I say the corporate value, that corporate value is the value of equity plus the value of debt. Value of equity plus the value of debt. So this is how the examiner is going to play you. Company A is going to buy Company B. How much should we pay for the shares of Company B? Company B shares is the value of its equity. How will you go and calculate that? Examiner will push you for you to calculate the free cash flow for whatever number of years. Then he will push you to calculate the WACC. So when you picture this, when we want this figure, I need to get the corporate value. So corporate value minus the debt value should be equal to my equity value. Okay, so this is how the examiner is going to play you. So to get this equity value, he forces you to calculate the free cash flows. He forces you to calculate the WACC. When I get the two and I discount to get the present value, I have got the corporate value. Having got the corporate value, if I deduct a value of debt out of it, it should give me the value of equity. So this is the template. This is the template you are going to play with. And most of you, when they are moving you like this is where the problem is. So remember, to get the equity value, I can get the corporate value by discounting the free cash flows with the WACC. Not cost of equity, with the WACC. If the WACC is given to me, pick it. If it's not given, I have to calculate it, come and discount it, get the corporate value, take the value of debt, and then you get the value of equity. And that will be your recommendation as to the amount we would have to pay. Okay, so that is that. Alternative way will be, we can calculate the value of equity straight using the free cash flows to equity. The equity value will be the present value of the future free cash flows to equity. because that cash flow is to only equity holders. So when I find the present value of it, the value should be given to the equity holders. The argument again, what discount factor should we need in order to discount the cash flows to get the PV? The discount factor should be appropriate. And this money or this free cash flow is for equity holders. I cannot discount the cash flow to equity holders with WACC, because WACC includes the cost of debt. So here it should be discounted using your cost of equity. So this is how the examiner is going to play you. So watch the movement, how I am doing this, because he's not going to give you the figure straight. He has to pick you from somewhere. You will have to do the connections in order to bring yourself to the equity value. So let's go to our note. We take this question to explain whatever I have done. Okay. Total Limited. The finance team of Total Limited has produced the following forecast of financial data: financial year X1 up to X4, net sales, cost of goods sold, selling and distribution expenses, capital allowances, interest, cash flows needed for asset replacement. Corporation tax is at the rate of 30% per year, payable in the year that the taxable cash flows occurs. Assume that the company's weighted average cost of capital is 14%. The market value of debt is 30 million. Calculate the value of the company if A, cash flows are expected to remain at S4 level into infinity. Cash flows are expected to remain at S4 level up to the end of 14 years horizon. Cash flows are expected to grow at the rate of 3% per year after X4 with overall horizon of 14 years. Cash flows are expected to grow at the rate of 3% per year after X4 into infinity. Cash flows are expected to grow at the rate of 5% per year after X4 to X6 inclusive, and then at 4% indefinitely. What I have to tell you here is that you're not going to get A up to E in the question. You are just going to get one of them. But your note has prepared it brilliantly the way I want you to learn, because one of these is what the examiner uses. One, they sat down to look at all the past questions to bring out the different ways the examiner is trying to let you calculate the present value of the future free cash flows. One of them is going to happen. I would have to emphasize that A and then D are the most common ones the examiner is using in the examination room. But all the other ones had come somehow, somewhere. So we need to learn all of that. So you make sure you are with me. Now, we said the corporate value is the present value of the free cash flows. They've given me accounting information forecast for the next 4 years. Therefore, if I want the present value of the future free cash flow, I have to get the free cash flow for year 1 up to year 4. Okay, then when I finish, I come and look at the terminal value. How many years far are we going? A is telling us we're going to infinity. B is telling us 14 years. C is telling us 14 years. D is telling us infinity. And then E is also telling us infinity. You don't need what I'm going to do only when you are doing free cash flows. You need it everywhere you are doing present value analysis. So it could be calculating MPV. And you need the future present value. How many years you will go? I can't stand here and say it. Examiner has got the right to do whatever. So we have to calculate free cash flow from this accounting information. So please flow with me. You picture your template of calculation of free cash flow, which is my operating profit or profit before interest and tax, less tax, add non-cash items, capital expenditure, working capital. This is my free cash flow. So they've given me sales, cost of sales, selling and distribution, capital allowance representing like depreciation. So when I pick sales and I less all my costs, it should give me my operating profit or profit before interest and tax, holding exceptional items out. Therefore, this is what we have done here for you. Okay, so be with me. So year 1 up till or X1 up till X4, we have brought in the sales. We've brought in all the costs, including the capital allowances. So the total figures here, when I take my cost, actually this one should have been 43, shift, it should be here. When I take my cost out of the sales, it should give me my profit before interest and tax. Okay? Therefore, what you need to remember, what you need to remember is that once I have got, this is my profit before interest and tax, then I need to apply my tax percentage on it. And the tax rate is 30%. So if you can do the free cash flow for year one, you should be able to do for whatever number of years. Then I need to deduct my tax. So 30% of the 43 is what is giving you the 13, and then 16 and that. When I deduct the tax, I would have to add back non-cash items. What was the non-cash item? It was the capital allowance. Capital allowance does not involve movement of cash. So come and add it back. When you add it back, is there any capital expenditure or is there any working capital increase or decrease? Question told you that capital or cash flow needed for asset replacement. Okay, it's a template. So you come and deduct that, and then you will come and get your free cash flows. So when you get the free cash flow, we need the present value of the future free cash flows. So what should we do? That free cash flows that we have got, we have to discount it using the cost of capital. What cost of capital? Because it's free cash flow, we have to use WACC. When you go to the question, you see the 14% WACC. Okay, that is given to you, 14% WACC. So I need to discount those cash flows by the WACC. Okay, that is why they discounted it at 14%. So when you discount it at 14%, you will get the present value for year 1 to year 4. And when you sum it, your total present value year 1 to year 4 is a 78.266. That bit, I'm okay with it. Now I am going to the question. A is telling you that your cash flows are going to remain constant at X4 level into infinity. Okay? Okay, it depends. The tax they can tell you is relevant years or tax is 1 year in arrears. If they don't tell you that, it is your choice, which I will recommend put it in relevant years and go, instead of you shifting it. Because when you shift it and you go into infinity, you have to separate them. So in order not to complicate it, it's always advisable to keep it in terms of relevant years with the tax, unless the examiner says something otherwise. Okay, so now, if you come here, it's telling you cash flows are expected to remain at X4 level up till infinity. Okay, let me bring your mind on something. When we say cash flow is going to infinity, we mean that cash flow is a perpetuity. How do we calculate the present value of a perpetuity? To calculate the present value of a perpetuity, it depends on whether that cash flow going to infinity is constant or is growing. I'm bringing your mind on something. You've learned this before. When you did your F9 and you did your dividend valuation, we said where the dividend is constant, your market price is the constant dividend divided by the cost of equity. When dividend is growing, the market price, which is the present value, is the D0, 1 plus the growth rate divided by cost of equity minus the growth rate. Unfortunately, we are not using dividend. We're using free cash flows. So we're going to say the PV, which is the value of the company, will be the free cash flow divided by the WACC if the perpetuity is constant. If the perpetuity is growing, we will say that free cash flow now, 1 plus the growth rate divided by the WACC minus the growth rate. This is the game. So if you know here, that's why I was telling you, what we're doing is not only applicable when it is free cash flow. Everywhere you are doing present values analysis, it should be okay. Now, point of attention. This formula is very deceptive. So let me complete it for you. This formula is based on the assumption that the cash flows will start from year 1 up till infinity. What if I am starting from year 5 up to infinity like the question in front of us? If you go to the textbooks, this is the formula you will see. The full formula is, having got this, you need to multiply by the discount factor of the base year, which I'm going to explain. Multiply by the discount factor of the base year. Okay, so that is the movement in here. Remember, this is the bit that most students forget. This is the bit that most students forget, because that original formula, this bit or that bit, assumes that the cash flow is from year 1 to infinity. If it's from year 1 to infinity, then your base is year 0. Year 0, any discount factor in year 0 is equals to 1. 1 times any number is that same number. So if it is starting from year 1, and then I come and put year 0 discount factor here, which is 1. 1 times this figure here will be the same, or 1 times that figure here will be the same. That is the reason why the formula is not bringing that bit. But what if I am not starting from year 1? So now let's go back to our question, and then we'll come and handle this. As long as I am going to infinity, I have got a perpetuity. Is it a constant perpetuity, or is it a perpetuity with growth? This is what I have to ask the question. Question is telling me will remain. So it's a constant perpetuity. If it's a constant perpetuity, then the formula I will need to get the present value from year 5 up to infinity should be the year 4 the year 4 cash flow divided by the WACC, multiplied by discount factor of my base. So I will say PV X5 up to X infinity should be, the cash flow is remaining constant at year 4 level. Year 4 level free cash flow we got. Let's go and pick it. Year 4 level free cash flow we got is this 32. So that 32 is staying constant up to infinity. So I will say that 32 divided by the WACC, which is 14%, multiplied by where did I base this 32 on? I base the 32 in year 4. So if I base it in year 4, it means I'm purporting year 4 to be like year 0. But I need the present value actually in year 0. A figure in year 4, when you wanted to bring it to year 0, what did you do? You discounted it by year 4 discount factor of 0.592. So we have to go and multiply by 0.592. And that is what they did in your note for you. So these are the formulas you are going to play with. Okay, so if you go to the note, you will see that they did that 32 divided by the 14 multiplied by the 0.592, and we got the present value. We needed the present value up to infinity. So year 1 up to infinity, year 1 to year 4, we made this. And then year 5 to infinity, we've made that. Therefore, what will be the PV year 1 to infinity? Sum up the two. And when you sum up the two, it's giving you what we refer to as your corporate value. So when you get the corporate value, this is the value of the whole company. If I needed the value of shares or equity, I have to knock off the value of debt. And the question said the company is having a corporate debt of, is it 30 million? Okay, that is this, 30 million. So when I knock off the value of the debt, I should get the value of equity. If you be able to do this, this is the main challenge and mergers and acquisition. Okay, so that is the value of equity. This is scenario A. You can have only one, not up to the E. Now let's go to scenario B. Scenario B is saying cash flows are expected to remain at S4 level up to the end of 14 years horizon. Here, we are not going to infinity. We're going to 14 years. We've done year 1 up to year 4. Year 1 up to year 4, we said the present value, as we did up there, is 78.266. Now, I will need from year 5 up to year 14. And they said it's going to stay constant at the year 4 level. If I get a cash flow which is constant from 1 year to another year, we call it an annuity. We all know that. We call it an annuity. How will we handle that annuity? Okay, how are we going to handle that annuity? The annuity here is this. I need it from year X5 up to X14. We all know the annuity table is the cumulative of the present value table. Okay, annuity table is the cumulative of the present value table. Therefore, if I pick annuity factor of the cost of capital 14% for 14 years, it means it has added from year 1 up till year 14. But I don't need from year 1, I need from year 5. Therefore, I will pick annuity factor 14%, 14 years, which is given 6.002. And I don't need year 1 up to year 4. Therefore, I have to deduct it from the total. I will also pick annuity factor 14% 4 years out. The figure I will get should give me annuity factor 5 to 14. Okay, so pick 14%, 14 years. It has added from year 1 to year 14. But I wanted year 5 to year 14. So I don't need year 1 to year 4. So go and pick annuity factor 14% 4 years, which has added year 1 to year 4, which is 2.914. When you take it out of the annuity factor 14 years, that will give you the annuity factor 5 to 14 years. And as such, you multiply by that constant cash flow and you get the PV. Okay, so what will be the total present value for the 14 years? Is the first 4 years plus the annuity from year 5 to year 14. And this will give you straightforward the corporate value. If you get that corporate value, obviously you can decide to knock off the debt value and you get the value of equity. Okay, so this is present value at its best. They are testing you annuity, perpetuities, and all that together. So make sure you are very comfortable. Now let's see C. I normally say that the requirement C strategy is the difficult among all of them. Okay, I'm doing relative terms. It doesn't mean it's too horrible. Okay, now let's go. Cash flows are expected to grow at the rate of 3% per year after S4 with overall horizon of 14 years. We are not going to infinity. The formula that we gave here, when it is growing, only happens when the cash flows is to infinity, which is perpetuity. Okay, so now if we go here to the question, the cash flow is growing by 3% at the S4 level up to 14 years. At S4, we said the cash flow is 32. Two ways. One way is a killer because it is going to take all your time. What somebody could have done will be, I will open year 5, year 6, year 7 up to year 14. I'm not encouraging you to do that because time will be of a problem. And secondly, you might not even have the space because even if you turn the sheet like that, you can't get 14 years on there. What about if the examiner does 44 years? What will you do? Okay, so make sure you are with me now. I am going to explain the stages in here. Okay, we did X1 and then X4. That is what we got the PV. Now we have to do X5 up to X14. This 32 in X4 is subject to inflation of 3% every year. So we would have done 3% here, 3%, 3%, 3% up to the year 14. But we can't open it. So what will I do? Instead of me inflating the 32, I will keep it uninflated. If I don't inflate it, it means that cash flow which was supposed to be inflated, that is not yet inflated. We call it real cash flow. We saw it last week. We call it real cash flows. So if I was supposed to inflate the 32 and I didn't, then I have brought it to real. If I have brought it to real, I cannot discount it using the 14% I would have used if I had actually inflated it. Therefore, I have to convert the 14% nominal to the real using the Fisher equation. And we all know the Fisher equation as 1 plus m is equals to 1 plus r, 1 plus I. And that 14% divided by 1 point inflation or growth rate was 3% minus 1 should give me the R. Everybody knows how to do this because we saw it last week. And then you are getting approximately, is it 11%? You are getting approximately 11%. So when I get this 11%, be with me. It means this cash flows that I was supposed to inflate at 32, that I didn't inflate, I am going to keep it 32 year X5 up to what? Year X14. And as such, because it's constant at 32, I have got an annuity. And that annuity, I have to discount it using the real, because this 32 between X5 and X14 is real terms. And therefore, I have to discount it using 11%. Okay? Now be with me. This is where most people get it wrong. How will I discount this? Remember, X1 up to X4. The 32 as at X4 was in nominal terms. So my real period does not start from year 1. My real period starts from year 5 up to year 14. Because that was the period I was supposed to inflate that I didn't inflate. So how many years was I supposed to inflate that I didn't? Year 5 up to year 14. Year 5 is inclusive. Therefore, it's a period of 10 years. Just as we can do. This is year 1 to year 14. So if this is X1 up to X4, which is 4 years, then S5 to what? X14 should be 10 years. So what will I do? I have to go to the table, pick 11% 10 years annuity. Okay? I am not going to pick 14 years. No way. Because that 14 years, the whole period wasn't real. The only period which is real is the 5 to 14 I ought to inflate. I didn't. So it is for 10 years I didn't inflate. That is the reason why if you go to your note, this is what they did to get 11. You go to the table, you pick 10% annuity, 10 years annuity, 11%. You multiply by that 32, and then you will get the PV for year X5 to what? X14 in terms of the real. And be with me, this is the last problem people have. Now, if we said that between X5 and X14 is 10 years, and we picked annuity factor of 11% 10 years, if this is 10-year period, then year 4 was year 0. This is what most people lose. Year 4 is our base. Therefore, when I discount it for this period, I have brought it to my base of year 4. Bringing it to my base of year 4. No, we can't do that. We cannot do 14 minus 4 because of the fact that you don't need this period as real. The period as real is only 10 years. Okay, let me do it again. From X1 to X4 is a nominal period. The only period which is the 32 kept uninflated is 5 to 14. So the real period is not starting from year 1. The real period is starting from year 5. And that period is 10 years. So you cannot do 11% 14 years and 11% 4 year off as we did earlier. The earlier one, the B, the 14% cut across. Therefore, we can do 14% 14 years minus 14% 4 years. Here, the 11% doesn't cut across. 11% start from here and end there. And that period is 10 years. Okay, so you can't do that bit. Okay, so let me bring you back. Therefore, if you discount this As we counted for 10 years, my base was X4 because I took the 32 from X4. Don't forget to discount it using the X4 discount factor. And the X4 discount factor that you use is what is called the 0.592 at 14%, because at X4 level, it was a nominal period. Okay, I know this is a bit demanding, so please have a look at that. There are so many tricks. So I summarize it for students this way. When they give you long period, I remember one of the questions, the examiner did it for 44 years, and you have to project. So what you have to do is, instead of you inflating, you don't inflate. You keep it at real. When you keep it at real, you convert the nominal discount factor using the Fisher equation, and you bring it to real. When you come to the real and you are counting the number of years you need for the annuity, you are not necessarily counting from year 1. You have to count from the point that you were supposed to have inflated, you didn't. Like here, we are counting from year 5. That's why we got the 10 years. And when you get that annuity, bring yourself to the base, and don't forget to discount using the discount factor of the base here. That is why here we are discounting by the year 4 discount factor to bring it to the true present value, and then add it to the normal year 1 to go and get what? The corporate value. Take the value of debt, and then you get the value of equity. So have a go through it. Any problem that you have, send me email. I would have to explain that to you if you happen to get a problem. So convert the discount factor from nominal to real. Don't inflate. Then when you are counting the years, count from the point that you actually was supposed to inflate, you didn't. And then when you discount it by the annuity factor, don't forget to multiply by the discount factor of the base year. Don't forget to do that. Okay, the D, as I said, is the most common one. Cash flows are expected to grow at the rate of 3% per year after X4 into infinity. This is infinity, and is the cash flow constant or growing? This one they told that is growing. If it is growing, this is the formula I need. So I come straight. This is easier. Okay, I come straight. So that is what we did here for you. So I will pick that 32 from year 4. The growth rate is 3%. WACC is 14%. Growth rate 3%. And don't forget to discount by the discount factor of the base year. Yes, the discount factor of the base year should be nominal, because in year 4, that 32 wasn't real. You were not supposed to inflate the 32 in real. That 32 in year 4. Year 4 is a nominal period. That's why I did it here for you. If you can see, this bit is the nominal period, and this bit is the real period. So when I come to year 4, I'm counting year 4 as 0, and that 32 in year 4 is a nominal rate. So you don't have to use the real rate. The real rate is a period of S5 only up to S14. Any period before S5 is a nominal period, because you were not supposed to inflate. Okay, I appreciate that, because that is what sometimes people get themselves confused. Okay, so let's go back to the D. So if you go to the D, you pick the 32, growth rate, WACC, growth rate. Don't forget to multiply by that discount factor. Don't forget to multiply by that discount factor. And this will give you the PV up to infinity. Add it to the PV year 1 to year 4. You get the corporate value. Take off the value of debt, and then you will get the value of equity. Now let's go to the last one. Cash flows are expected to grow at the rate of 5% per year after X4 to X6 inclusive, and then at 4% indefinitely. Okay, as long as indefinitely had come in, you are going to perpetuity. And when you are going to perpetuity, you ask, is it a constant perpetuity or perpetuity with growth? It's a perpetuity with growth of 4%. However, question is telling you it will grow by 5% from X4 to X6 inclusive. So it means you have to grow the 32 by the 5% to go to X5, grow it again to go to X6, and the perpetuity will start from X7 to infinity. So we have X5, That 32, you grow it by 1.05 or 5%, you get the cash flow for X5. You go grow it again to get for X6. And then you take the 14% normal, X6 and S5, 14% discount factors, you get their PVs. Then from X7 to infinity, you have got the perpetuity, and that perpetuity is growing. So what formula do you need? I need the perpetuity growth formula, which is the cash flow now. If I'm starting from year 7 to infinity, my base is what? Year 6. That is why you see year 6 cash flow coming down here. Okay, that is why you see year 6 cash flow coming down there, and then it's growing by 4%, WACC 4%. Don't forget to discount by the discount factor of the base year. The discount factor of the base year is what is killing many students in the room. They tend to forget about it. Okay, and what base year? You base it in year 6. And what is year 6 discount factor? That is what we have put here. Okay, that is what we have put there. Sum up all of that. You add it to the year 4, 1 to 4 PV. You get a corporate value. Take the value of debt, and then you will get the value of equity. So this is free cash flows. And as I said, don't worry yourself that, oh, it is only free cash flow. It's everywhere. Sit down. Look at the movement. Okay, I would have to say it is the A or the D, which is the most common one. When they do annuity and they don't go to infinity, they keep you up to some number of years. It's a bit tricky. Okay, it's a bit tricky. So look at the B and the C well, very, very well. The B and the C. Look at it very well. But as I said, most cases, it goes to infinity. Okay, now let's go to the next topic. Duration. We all did, we all did investment appraisal techniques. We said we can use MPV. We've also seen internal rate of return. We've seen modified internal rate of return last week. There are other techniques we need to learn, which will be the duration and then adjusted present value we will see later. Okay, this is duration. So what do we mean by duration? Okay, what do we mean by duration? We all did payback period, and we said according to the payback period, we recover how many years the cash flows will recover the investment. And payback period was criticized on the basis that it does not take into consideration time value of money, and it doesn't consider the total profitability of the project. So they brought in the discounted payback. Discounted payback only took into consideration the time value of money, but yet it did not consider the cash flows over the project of the project life. Simple. The common argument here is that if I've got project A and project B, I've got project A and project B. This is 100 initial investment. 100. Assuming I have their PVs, year 1, year 2, year 3, year 4 PVs. This is, let's say, 50 PV, 50, 10, and then 5. This is PV of 20, present value. I'm creating them in terms of present value. This is 30, this is 50, this is 60. What would you say? If you are looking at discounted payback, you would have said, Project A will go over 2 years, discounted payback. Project B will go 3 years. What will happen? What will happen is that we will select Project A over Project B. But we all learned MPV is the master because we have to maximize the shareholders' wealth. What will be the MPV here? The MPV here will be only 15. The MPV here will be 60. So if we have to go by the discounted payback, because it did not consider the cash flows, the present values of the cash flows beyond the payback period, it will deceive us for taking project A. But A and B would have maximized our shareholders' wealth better. So the criticism based on the payback period and accounting rate of return, the payback period and the discounted payback period, those criticism brought about duration. Because discounted payback, even though takes into consideration the time value of money, it doesn't consider the present value of the cash flows all over the life of the project. So now we need a new form of payback period. We need a new form of payback period that actually take into consideration the time value of money and the total present value over the life of the project. That payback period is what is called duration. So duration is a payback period measuring on average the number of years the present values of all the cash flows associated with the project will be able to recover your investment. So duration is simply a weighted average. Don't bother. You don't need to do anything much. So duration is a weighted average of the present values of all the cash flows recovering the investment, and it will give a conclusion which is consistent with the NPV. Discounted payback or payback will be somewhere different from NPV, as I illustrated here. Because if you see here, NPV is 60, NPV is 15. Which one will lead to maximization of shareholders' wealth? Obviously, it's B, but discounted payback period would have gone for A. So we need the one that will consider all the present values of the cash flow, just as NPV does. And that one is what is called the duration. And duration is the weighted average. And when I'm teaching duration, I tell students, you don't have to bother with it. Because what is weighted average? If I tell you to calculate weighted average from day-to-day life, weighted average, the weighted average is simply called the mean. And we all learned mean from our primary school or secondary school mathematics. Mean, arithmetic mean, is calculated as sigma fx over sigma f. So for me, when I'm learning and I'm learning duration, I just tell myself to calculate duration, I am calculating mean number of years, full stop. I don't bother my time to read again because I know how to calculate mean. What is my F? I need the duration to be the weighted average number of years. And my X is the number of years. My Y, F, is the present value of the cash flows. Okay? F is the present value of the cash flow. Just like you are calculating mean. You said frequency and then the max. You want the mean, the average, the weighted average mark. The weighted average mark. Here, we want the weighted average number of years. So X is the number of years, and then the F is the present value of the cash flows. How many years weighted average? I will use the present values of the cash flows surrounding all the project to recover the investment. So this is what we're going to do. In your note, we presented it in a different way. It's a note, but in the exam room, you haven't got the time to present it that way. So I'm going to do it in a very simple way for you to follow. Now, when you have to calculate the present value, we need a discount factor. And your syllabus want you to calculate the duration either using internal rate of return as the discount factor or using the cost of capital as the discount factor. All of them should give you the same answer anyway. So let's go to our note. I picked the question to illustrate. Okay, I picked the question to illustrate. Don't bother yourself reading this one because I'm using the mean principle because everybody knows how to calculate the mean. Okay. I'm not going to present it this way for you. I'm presenting in the mean way. When I finish, I'll explain this. Okay. The forecast cash flows relating to a proposed project are year 0 up to 4. Okay. Establish both the duration to recover the original investment using the internal rate of return as the discount factor, duration to recover the present value of the project using a cost of capital of 8%. Okay. If you want me to calculate this duration, my eye is not anywhere. As long as you tell me to calculate duration, I am looking for the mean because it's the weighted average. How do I calculate the mean? Sigma fx divided by x. What is x? X is the number of years. This is the number of years. What is the present value? F is the present value. What is the present value? Present value is the cash flows discounted using a cost of capital or a discount factor Which one should I use? They can ask me to use internal rate of return. They can ask me to use what? The cost of capital. All of them will give you eventually the same answer. So that is what we're going to do straightforward here. Okay, so I will say I am using the duration, but that duration, I am going to discount the cash flows using the internal rate of return. How many years? Year 1, year 2, year 3, year 4. Okay. And the cash flows there, these are the cash flows: 7,600, 16,500, 13,000, 6,600. Discount factor, according to the question, the internal rate of return is 11.13%. What will be the figures? You can approximate it to 11% and go. I normally use my calculator. So 1 divided by 1.1113, that gives me about 0.900, divided by 1.1113, that gives 0.810. Press the equal sign. 729, press the equal sign. 656. What is the PV? So 7,600 times 0.9 is 6,840. 0.810 times 16,500 is 13,365. 0.729 times 13,000 is the 9,477. 0.656 times 6,600 is 4,330. Okay, we said the duration is the sigma fx. X is the number of years, so this is my x. PV is the f, so what will be my fx? Okay, what will be my fx? I need to multiply 1 by that. 1 times that will give you 6,840. 13,365 times 2 will give me 26,730. 23,730. 9,477 times 3 is it given 28,431, and then 4 times 4,330 is it given 17,320. I need sigma fx divided by sigma f. I need to sum up this, sum up that. Obviously, when I discount present value, I discount cash flows using a discount factor, which is internal rate of return. Internal rate of return is the rate that will make the NPV equals 0. So what do we say? What we're going to say here is that if you sum up this, it should be equal to the initial investment. But when you sum up, if you don't pick it and you sum up, you come back to the same answer. So you will say 6,840 plus 13365 plus 9477 plus 4330. That is given 34,012. If you go to the question, you see that the initial investment is 34,000. It's the approximation that is making the difference. Because when you discount the cash flows with internal rate of return, the present value of the future cash flow should be equal to the initial investment for the NPV to be equal to 0. So if I'm discounting using internal rate of return and I need this total, I wouldn't even bother myself adding it. I know the total here should be approximately equal to the initial investment. I'll put a 34,000 there and I'll move on. So 6,840 plus 26,730 plus 28,431 plus 17,320 is giving me 79,321. What then is the duration? Duration is the mean, and the mean is the 79,321 divided by 34,012. So divide by 34,012, 34,012, and that is giving you 2.3 years. So on average, we will recover the investment within 2.3 years. So this is the internal rate of return approach. If you know one, you know the other. If I have to discount using the cost of capital approach, it's going to follow the same principle. The only difference is I'm going to put 8% here. Okay, so if I have to use the cost of capital approach, still years. Year 1, 2, 3, 4. Bring the cash flows. Cash flows here 7,600, 16,500, 13,000, 6,600. What discount factor? They said the cost of capital in this case is 8%. 8%, go to your table. 8% year 1 divided by 1.08, 0.926 divided by 1.08, 0.857. Press the equal sign, 794,735. What then is the PV? Okay, 0.926 times 7,600. That is 7038. 16,500 times 0.857. That is 14141. 0.794 times 13,000. That is 10322. 6,600 times 0.735, and that is 4851. This is my F, this is my X. So what is the Fx? 1 times this will give me 7038, then 2 times 14, 141, and that is 28282. Then 10322 times 3 years is 3966. 4851 times 4 years, this is 19404. This is not going to give you the initial investment because we didn't discount using the internal rate of return. So 7038 plus 14141 plus 10322 plus 4851, that is given 352. 7038 plus 28282 plus 3966 plus 19404, and that is 85690. What then will be the duration, which is the mean? 85690 divided by 36352. Okay, by 36352, and that is given 2.36 years. It's approximation that is causing the difference. So this is basically the duration. This is basically the duration. So when they tell you to calculate duration, you are calculating mean. It is a payback period, but it's the new form of payback period that takes into consideration the time value of money by discounting, and then taking into consideration the total cash flows over the life of the project. And as such, it's likely to give a conclusion which is more consistent with the NPV. Okay, so let's go to our note. You see that, okay, what they did here, when they discounted, they divided each of them. They divided each of them by the 34,000, multiplied by that and added. It's a long form of mathematics. That is what I've done. Is simple for you, so that you don't have to divide the 34,000 5 times or 4 times. You just divide it once and you go. Okay, so you see the figures that we got is the same as that. We are simply calculating a mean. Okay, so you don't bother yourself to learn it too much. As long as you know how to calculate the mean, that's it. The only thing you have to pick there is that my number of years is the X in the mean formula, and the present value is the frequency. Okay, next, let's go to Frederick Macaulay duration method. Frederick Macaulay duration. If you know duration, you know Frederick Macaulay duration. They are all duration, but we are using this to separate them. Duration as it is, or as we calculated, relates to only project, like I'm doing a capital project. That is duration. But when you talk about Frederick Macaulay duration, you are calculating the duration for a financial asset, specifically a bond. Bond is an investment that you are making. So when I buy the bond now, I'm going to get cash flows over the future period, isn't it? How many years I'm going to use on average the cash flows, present values of all the cash flows associated with the bond to recover the investment that I made. So it's a duration. So it is normal duration calculation, everything the same. The only difference is that Frederick Macaulay specifically is in relation to bond, and normal duration is in relation to capital project. Examiner might not necessarily tell you using Frederick Macaulay or using whatever. He's going to tell you to calculate duration. So when you see that it is a capital project, it's duration. If you see that it's a bond, it's Frederick Macaulay. Nobody needs that distinction. The most important thing here is that, do you remember that that duration is the mean number of years? Whether I'm calculating it for a bond or I'm calculating it for a capital project, it follows the same principle. So let's take this question to illustrate. 7 years prior to the maturity of a bond with a 100% coupon, it is trading at a price of 95.01. Okay, how did I get that? The question gave it to us, but that is the internal rate of return. So we know how to calculate the internal rate of return. This is where I got it from. Okay, that is the internal rate of return. So if the examiner wants you to calculate the duration using the internal rate of return approach, and that internal rate of return is not given to you, then the examiner is first of all expecting you to calculate the internal rate of return of these cash flows, which we all know how to calculate that internal rate of return. So if I calculate the internal rate of return of these cash flows, I am going to get 11.13 before I will go and calculate the duration. Okay, and that is a very good question because it's a question the examiner asked some time back. He didn't give the internal rate of return. He just gave the cash flows, and students were supposed to calculate the duration using the internal rate of return approach. So what he was expecting is, you ought to know that if I have to calculate the duration using that internal rate of return approach, I need to get the internal rate of return as a discount factor here. And then when I get a discount factor, I will discount the cash flows with the internal rate of return to get this before I'll be able to get these two figures to get the duration down here. And this is what students were not able to picture. They came out and said that, oh, he wanted us to calculate duration, but he didn't give us internal rate of return. And that is what I always tell you. Whenever you're doing some of these calculations, you need to picture it. Because before I will be able to get this duration, I need cash flows. I need a discount factor. Before I will get the PV, before I will get the FS, before I will be able to calculate the duration. So if I go to the room and the examiner wants me to calculate the duration, he hasn't given me cash flows. How will I calculate the cash flows? From sales, variable costs throughout to tax savings and capital allowances, working capital to come and get this net cash flows. I need internal rate of return or I need WACC. If the examiner hasn't given me the internal rate of return, once I've got the cash flows, I can assume my own two rate to calculate the internal rate of return as we did last week. I come and get the internal rate of return, discount those cash flows with that internal rate of return, get the PV, get the FS before the duration will come up. That sort of connection is some of what some of you are lacking. Okay, there's not going to tell you in the question, calculate internal rate of return and then calculate duration. He will expect you that if you know how to calculate the duration, he will expect you to calculate the internal rate of return, calculate the cash flows. Okay, but the lecture note is prepared on the basis that we've shown you how to calculate net cash flows, we've shown you how to calculate internal rate of return. So I am not coming back here to explain or calculate that internal rate of return. So this is the link you would have to be doing. Please, this is the link. Okay, very, very good question. That brings my mind to what he did. Okay, same way, if you go to bond duration and the internal rate of return is not given to you, you would have to calculate that internal rate of return. You would have to calculate that internal rate of return before you'll be able to move on. Otherwise, you can't calculate the duration. Okay, the good news about bond duration is that there is no separation between using cost of capital approach or using the internal rate of return approach. If it's a capital project, internal rate of return might be different from the cost of capital. But if it's a bond, as we learned from F9, the cost of a redeemable bond is its internal rate of return, is yield to maturity. Therefore, if you are separating it, this figure as the internal rate of return is the same as the cost of capital. So there's only one way. All what you have to do is you have to discount it using the yield to maturity, which is the internal rate of return. So let's quickly go and have a look at this question. Okay, so please, when you are learning some of these things, don't learn them individually. Oh, when I was doing MPV, this is what we did. When we are doing this, this is what we did. No. See all of them together and establish the relationships between them, because the examiner is not going to lead you and then he will be hiding certain things before the final answer. Okay, so watch out for some of those things. And that is what I normally handle when I'm doing the revision, so that I'll establish most of the relationships for you. So let's go. 7 years prior to the maturity of a bond with a 10% coupon, it is trading at a price of 95% and has a gross yield to maturity of 11.063%. Using Frederick Macaulay's duration, calculate the bond duration. Okay, I have a bond that is left with 7 years to go. I have to pay 95.01 now. That is the market price. There's a coupon rate of 10. Coupon rate is the same as the interest rate. Because it's percentage year, it means the nominal value is 100. So what will be the cash flows associated with this bond? Every year, I will get interest of 10% of the 100. So I'll make 10 from year 1 up to year 7. Then come the end of year 7, I would have to make what? My redemption value, which is 100. And then the internal rate of return is what is given to you as gross yield to maturity. If it's not given to you, you would have to calculate it, which we know how to calculate internal rate of return given a cash flow. And I will discount it with that internal rate of return and I will calculate the mean. So what will I do here? I am going to say year 1, 2, 3, 4, 5, 6, 7 years. What will be my cash flow? Every year I am going to get interest of 10. But when I get to year 7, I'm going to make the 10 plus the 100 nominal. I need to discount it using the internal rate of return. Internal rate of return given is 11.063%. I pick my calculator quickly. 1 divided by 1.11063. You can do 11% and you go. This is 0.900 divided by 1.11063. This is 0.811. I press the equal sign. 730 657 05192 0533 0480. What is the PV? Can I say 9, 8, approximate 7, 7, 6, multiplied by that 5, 110 times 0.48, that is about 53. No, 1 minute. Yeah, 110 times 0.48, that is about 53. This is my F, this is my X. So what is the FX? 1 times 9, 9, 16 here, 21, 28, 5 times, that is 30, 30, then 7 times 53 is giving me 371. Because I discounted the cash flows with the internal rate of return, it should give me that. Yes, because when you get to year 7, you would have to get your interest plus the redemption value. They didn't tell us a specific redemption value, so the natural assumption is that it should be at 100. Okay, it should be 100. So I get 100 plus the 10, that is giving the 110. Okay, just same argument. Because I discounted with internal rate of return, this should be equals to the market price, which is the initial investment. And that market price is 95. If you sum them up, 9 plus 8 plus 7 plus 7 plus 6 plus 5 plus 53, that is giving you 95. Okay, as I said, if you know the movement, you don't have to waste time to add. You just put the investment in there. So 9 plus 16 plus 21 plus 28 plus 30 plus 30 plus 371. That gives me 505. And as such, what is the bond duration? Okay, is it 505 divided by 95? Divided by 95, that will give you 5.31 years. Okay, so what I would advise you is you don't waste time here. The only thing that you need to remember is you are calculating mean. If the cost of capital is not given to you, or the internal rate of return is not given to you, the cash flow is not given to you, it's your job to read the question in front of you and you calculate your net cash flow normal using the relevant cash flow principle. I get the net cash flows, then I need internal rate of return. Question, give it to me. If the question don't give me the internal rate of return, the net cash flows that I get, I assume my own two red. I calculate my internal rate of return. Then I pick those cash flows again. I discount it using the internal rate of return. Get the PV. Multiply the PV by number of years, get the FX, sum them up, divide, then duration comes. Okay, the examiner is not going to go straight. This is the cash flow. This is the internal rate of return. Calculate duration. It doesn't work like that. Okay, I know we are behind time. The day's objective has not even been started. So now let's go to the day's objective. So when you, at your own time, you can start or prepare to calculate this duration for these examples, okay? Okay, there's no, in terms of principle, there's no difference between Macaulay duration and then normal duration calculation. They use Macaulay to refer to bond duration, like financial asset, when you are investing in financial asset. But we refer to duration when it's a capital project, like we are buying a house and we are renting it out, or we are embarking on buying an equipment to produce something. But all of them, they are just duration. The mathematics is the same. The only thing is that Frederick Macaulay is specific to bonds, and the normal duration is to any capital project. So don't separate them. Don't bother yourself. Don't separate them. If you go there and you see Frederick Macaulay duration, you are calculating mean. If you go there, you calculate duration, you are calculating mean. Okay? I think even last two sittings, he asked a question on Frederick Macaulay. He didn't even mention Frederick Macaulay. It was a bond. So as long as there is a bond and they tell you to calculate duration, it's Frederick Macaulay. If it's a capital project, they tell you to calculate duration, it's duration. All what you need to remember is you calculating a mean. Okay? So I push you straight to chapter number 3. Which was supposed to be the main thing, but I'm still happy because the free cash flow, the chapter number 2, look at different things we've done in chapter number 2, and I'll be referring you to chapter number 2 because topics we are about to be doing in the near future, we will need that principle. So I'll be referring you to my advice is you make sure you capture the chapter number 2 very well. Okay, investment appraisal 2, which deals with capital rationing and risk and uncertainty. So let's go straight to capital rationing. What is capital rationing? We all said that the investment that we have to undertake, if it gives a positive NPV, then we should undertake the investment. The second decision we would have to make here is, where are we going to raise money to finance that profitable investment? If you calculate the NPV is positive, it means you have to do it. How will you do it? You need money to finance it. Have you got enough money to finance all projects that will give you positive NPVs? Obviously, the answer is that because we don't live in a perfect market, it might be possible that you are not having enough money to finance all projects with positive NPVs. So the common sense is the limited capital you have, you would have to ration. You would have to use that limited capital on those projects that will give you the highest combined NPV, and that is what is called capital rationing. So where you haven't got enough money to finance all projects that will give positive NPV, then the limited money is supposed to be rationed, and that is what is called capital rationing. Question here is, why companies haven't got enough money to finance all projects? and that is what is called the causes of capital rationing. There are two causes of capital rationing. First one is soft, which is also called internal capital rationing, and that comes about when management places a limit on the amount we want to spend now. It's an internal management decision. Management can change their mind, and then we will be able to have access to money. We do it in our personal lives. Sometimes we place a budget. Oh, this month I want to spend only 1,000. Okay, you wouldn't want to go beyond 1,000 for reasons that are peculiar to you. So there might be certain things you wanted in that month, but because you've placed the limit on how much you want to spend, you don't want to even look at it. It's the same thing management is doing. So soft capital rationing, why will management want to sell it? They want to sell it because they don't want to raise money by way of issuing shares, because they believe that when they issue shares, they might dilute what? Control. Or when they issue shares, they will dilute earnings per share. Or they don't want to raise debt capital, because when they raise debt capital, it might increase gearing and financial risk, or it might force them to be paying interest, fixed interest every year, and they wouldn't want to do it. In other words, management would like to cap it. Why? Because they want to cut their quota according to their size. Or what they want to do is that they will want to finance every project out of what? Their cash reserves. So if our cash reserve is £10, we do £10, just as we do. Some of us, all what we do is that I want to finance everything out of my savings account, even though bank manager is begging you for loan, because you don't want to be in debt, because you don't want to pay interest. You don't want to look at it. You just want to finance everything out of your savings. The same thing. This is your soft capital ration. The same thing that directors are doing there. The hard capital rationing is coming as a result of external factors, which is preventing the company from raising money. And why external factors? Because share prices are down. People don't want to buy shares. Investor confidence in the market is very low. So if you want to go and issue shares, market prices are very, very low. Nobody wants to buy it. Okay, you can't force it. You can't change it because it's not your decision. It's decision made by somebody outside. It's hard on you. Okay, or your company is seen to be very risky, or the cost associated with raising the money is too expensive. So you forget about that. So you can have a look at that. Where I am interested here is types of capital rationing. There are two types of capital rationing. We've got what is called the single period capital rationing and multi-period capital rationing. And now be with me. The calculation coming, this is how I expect you to interact with the question. If you don't interact with the question, you might be leaving so many things. So when the question comes as calculation and the examiner asks me to ration the capital, my first question to the question in front of me is this your capital structure a single period capital structure, or is this your capital structure a multi-period? Single period, the lack of money is there for only 1 year. Multi-period, the lack of money is there for more than 1 year, as the name suggests. Okay, so if it's a single period capital rationing because the lack of money is there for only 1 year, the next question you have to ask the question is, are your projects divisible or non-divisible? The reason is that every project and the type of capital rationing, the way you would have to allocate the money is different. So if you misjudge it, you allocate it differently, and obviously you know what is happening. So ask, am I in single period or am I in multi-period? Then are the project divisible or non-divisible? So that is what your note has done for you. If I am in single period and the project are divisible, then I have to allocate it on the basis of the profitability index. Okay? If I'm in a single period and the project are non-divisible, or somebody will say indivisible, then because I can't take the project in bit, I would have to take it either as 100% or I don't take it at all. Therefore, I will need combination of project that will give me a total cost which is equals to or less than the capital I have available, and it will give me the highest combined NPV. This is what most of you say try and error. I have to try and error it to come out with combination of project. And when I get the combination of project, the total cost should not be more than whatever monies I have, because I can't spend more than I have. So it should be either equals to or less than that amount. And my objective is to maximize the shareholders' wealth. Therefore, that will give me the highest combined NPV. Combination of project, total cost equals or less than the monies available, that will give me the highest combined NPV. These are the 3 stages. So that is the single period. If it's multi-period and the projects are divisible, you would have to use linear programming. You see how the argument goes. So if you don't lead yourself through the question, it might be multi-period and you are locating it on the basis of profitability index. You are totally somewhere. So you have to interact with the question in order to know which one I have to be using. Okay? So if it's multi-period and it's divisible, you would have to use linear programming. Your syllabus wants you to know too. Either linear programming to maximize NPV or linear programming to maximize the cash flows available to pay dividend, which we're going to do all of that. The second one is if the projects in a multi-period are indivisible, then you would have to use the integer programming. Okay, so we're going to take figures to illustrate quickly. So let's take this example, Banding Limited. Banding Limited is a highly geared company that wishes to expand its operations. 6 possible capital investments have been identified, but the company only has access to the total of 620. The projects are not divisible and may not be postponed until a future period. After the project ends, it is unlikely that similar investment opportunities will occur. Expected net cash inflows, including salvage values, Project A up to F. Project A and E are mutually exclusive. All projects are believed to be of similar risk to the company's existing capital investment. Any surplus funds may be invested in the money market to earn a return of 9% per year. The money market may be assumed to be an efficient market. Banding's cost of capital is 12% per year. Required A, calculate the expected net present value, the expected profitability index associated with each of the 6 projects. Rank the project according to both these investment appraisal methods and explain briefly why these rankings differ. Give reasoned advice to Banding Limited recommending which project should be selected. Okay, if you look at this question, the A hasn't told me to do capital rationing. The A just told me calculate NPV, calculate profitability index, rank, and then talk about why that difference. It's the B that is telling me to advise which project should the company undertake. In other words, what should be the investment plan? Because I've got all these projects, is it possible for me to undertake all of them? It is only possible if this monies, if I sum up them, it's no more than that. So the A, you are asked to calculate NPV, profitability index. And F9, we all know how to calculate profitability index. Let me bring your mind on. Profitability index, PI, is NPV divided by the initial investment, or is PV divided by that initial investment. Normally, I have got a problem with it. I normally say NPV divided by the limiting factor, because it is not always that your lack of money will occur in year 0. If the lack of money should occur in year 1, you have to put the period that the cash outflows in the period in which you lack the money. Okay, so it should be the limiting factor. If the limiting factor, like in this case, is the cash outflow in year 0, you put the initial investment. Okay, so now let's go to the note. Everybody can calculate NPV given these cash flows for each of the project at a cost of capital of 12%. So we did it here for you. Okay, we did it here for you. So A was 70,000 every year, and as such we use annuity. Take the initial investment. This is the NPV. Everybody will be able to calculate the NPV for this. It should be a straightforward one. So all of them, these are the NPVs. Technically, any project that is giving us a negative NPV is not worth undertaking. It should be what? Eliminated out of the equation. unless the examiner specifically tell you that that project given a negative NPV is still supposed to be undertaken. In that case, you have to follow that instruction. But if there's no instruction of that effect, then that project with a negative NPV automatically will reduce our shareholders' worth, push it somewhere. It's out of the equation. Calculate the profitability index. They calculated it as the present value divided by the initial investment. PV divided by initial investment. They got the profitability index. Straightforward ranking. You pick from the highest profitability index to the lowest. You pick from the highest NPV to the lowest. So that should be straightforward. Okay. Why profitability index and NPV will give different rankings? They will give different rankings because NPV is an absolute measure. Profitability index is relative to the investment. We said PV divided by initial investment is relative. So it's the same argument as internal rate of return and NPV. Profitability index is a relative measure and NPV is an absolute measure. What I am interested here is the B. Because A, you are just calculating figures. Okay, to be honest with you, when they asked this question as a past question, most students got confused because their argument was the project, they said they are non-divisible. We have a single period capital rationing because we have only one constraint and the project were non-divisible. Why the examiner is asking us to calculate profitability index if the project are non-divisible? You see the argument? Okay, but the examiner at that point hasn't told you to rank or hasn't told you to ration capital. He just told you calculate, so calculate it. When he tells you to ration it, that is when you would have to say, I am in a single period capital rationing because lack of money is there for only once, which is the 620. And project, are you divisible or non-divisible? I am non-divisible. So if I'm non-divisible, I need combination of project that their total cost will be equals or less than the 620,000. That will give me the highest combined NPV. This is your focal point. Okay, so just follow the instructions. Okay, so when I come to the B, that is where I would have to think of rationing the capital. So what did we do? Let's go there. Okay, before I will go there, let me explain something in here. We need combination of projects that the total cost will be equals to the capital available, and it will give you the highest combined NPV. If I am going to look for the combination of the project, I will need to ask myself a question. The question is, are any of those projects there mutually exclusive? Because we all said projects which are mutually exclusive cannot be undertaken at the same time. That's why I always tell my students, lead yourself through the question. If you don't lead yourself, you will skip something. So when I am going to look for the combination, I shouldn't have any combination that will include projects which are mutually exclusive, because those two projects cannot be undertaken at the same time. Question had told me A and E are mutually exclusive. Therefore, I don't need any combination which will include A at the same time E. C, we said C is having a negative NPV, so it's gone. So which combination? I can do A, B, D, and F. Is it possible for me to do that? This is the argument. That's why they said it's try and error. You have to try it. Is it possible to do A, B, D, and F? How will you know that is possible? You have to add their investment. You have to add their investment. When you add them, is it equals to or less than this 620? If it is more than that, then it's not possible. If it is within up to the 620, then it's possible. When it's possible, you also add their corresponding NPV, because you said you need combination of project that their total cost falls within the amount that will give you the highest combined NPV. So this is the argument, and this is the combination that we were able to do for you. This is the combination we were able to do for you. Okay. So we did ABD. Look at the total cost of ABD. It's giving you 606. It's within the 620. We did ABF. All of them, all those combinations, you see that their total cost falls within the 620 available. So sit down and look at the payment. And then remember, we won't see A at the same time E on the same line. That's why you don't see it there. We wouldn't see project C because project C is out because of negative NPV. And then when you get their cost, which is within, you would have to also sum up their respective NPVs. And these are the total NPVs of the combined project, because you said you needed combined project that their combined cost falls within the capital available, and it will give you the highest combined NPV. So which one is giving me the highest combined NPV? It's 19,637. And as a result of that, we will say the best way of spending the money is to invest in ADF. So that is basically the procedure. If it is single period and it's indivisible, I need combination of project that their total cost falls within the capital available. That gives me the highest combined NPV. That is basically that. This is almost the same as what you did in your F9. Now let's move on to the next. Multi-period capital rationing. We all said where there is multi-period capital rationing, the lack of money is there for more than 1 year. Okay, and if the projects are divisible, you would have to use linear programming. If the projects are non-divisible, you would have to use what is called the integer programming. The linear programming for divisible project, examiner wants you to achieve two objectives. And the two objectives, one is to maximize the shareholders' wealth by way of maximizing NPV. The other one is maximizing shareholders' wealth by way of maximizing the cash flows available to pay dividend. We're going to show you all of that. The good news is this. When you see multi-period capital rationing, it's a good news for you because you are not going to solve equations. NCCA is expecting you to just form equations. So it's not very popular. It has been in P4 only once. Okay? You are just forming inequalities because you can't solve it manually unless you have done matrices, okay, which ACCA is not expecting you to do that. So you are doing only equations. Either you can use matrices or computers to do. So here we are just forming equations. So let's take this question to illustrate. Example of multi-period capital rationing using linear programming, Barney Limited. I normally tell students, obviously, this is sometimes what worry us because we are used to the moment, oh, the heading. In the room, nobody gives you the heading. So I always want you to encourage yourself to deduce. Because if you can't deduce, you can't get to the answer. This is typical of P4. The answer, you definitely know it. But how you will get there is always the case. Okay? The management team of Barney Limited has identified the following independent investment projects, all of which are divisible. Big sentence. Divisible here. So the moment I finish reading this sentence, I should pick something out. Divisible. Okay, I've got divisible project. No project can be delayed or performed on more than one occasion. The projected cash flows during the life of each project are as follows. Year 0 up to year 4. And then I've got the project A up to F. The capital available at year 0 is only 50,000 and only 12.5 is available at year 1. I've seen two constraints. So I have found myself in a multi-period capital rationing. Are the project divisible or non-divisible? Divisible. So if I found myself in a multi-period capital rationing and projects are divisible, then I need to use linear programming. This is how I would lead myself to bring myself to that linear programming. So that is the case. Okay, from year 2 onwards, there is no restriction on the access to capital. The appropriate cost of capital is 10%. Formulate both NPV linear programming and PV of dividend linear programming. For the sake of our time, I'm just doing the one, and when I see you next week, we will pick the second one, okay? Now, when you have to do the linear programming, as I said, you are just forming equations. And how do we do the linear programming? This is what I advise. It follows the following stages, so be with me. To do that linear programming, first, we have to define the unknowns. 2, we have to define the objective function. And then 3, you have to define your constraints. And then 4, you have to define the non-negatives. Okay, so that is what you would have to do. That's it. So we're going to apply. So when we go to the question, what will be the unknowns? That is the first thing we have to do. We have to do project A up to project F. These are the available projects. Okay? These are the available projects, A up to F. Okay. The projects are divisible, meaning we can undertake part of the project and we enjoy the benefit that goes with that part. Okay? So, if I pick project A, I can do 100%, I can do 0%, I can do whatever percentage. Do I know that percentage specifically I will do for each project? That is what I'm struggling for. Which project I should undertake and what amount should I undertake as being divisible. So your unknowns are what proportion of each of those projects you are supposed to undertake. So you say, let's say small a represent the proportion of project A, small b represent proportion of project B up to F. So that is what we did here for you. Okay, so come here, you flow here with me. So this is your unknowns, 1. This is the definition of the unknowns. So when I define the unknowns, I've seen let A represent the proportion of project A, B represent proportion of project B, like that. Okay, my second definition is the objective function. What will be the objective function? My objective function depends on what linear programming I'm asked to do. We said we have to do linear programming to maximize NPV or to maximize the cash flows available to pay dividend. The A, we are starting with maximizing NPV. So my objective function is to maximize NPV. If I have to maximize NPV, I will need NPV of each of the projects. So you go to the question, you ask the question, what are the NPVs for each of the projects? Question didn't give me the NPV. Question gave me cash flows and it gave me cost of capital of 10%. So I have to calculate the NPV for each of these cash flows. And that is what we've done here for you. NPV calculation giving cash flows and discount factor is straightforward. So we calculated the NPV for you. Okay? You don't just go straight to calculate NPV because nobody has told you to do that. Let it bring itself. So when I get to the objective function and I need to maximize the NPV and the NPV is not given to me, that calls for that calculation. If they are given to me, then straightforward, I pick it, I carry on. Now be with me. We said small a will represent proportion of project A. If I do all of A, I will make this NPV. So if I do 10% of A, I would have to enjoy 10% of that. And that proportion of A is what we are representing as the small a. Therefore, the MPV from A will be the 21.9 multiplied by that proportion I have to undertake of A. And that proportion is the small a. That is why when you come here, you see the MPV of A here multiplied by the small a. MPV of the B multiplied by the small b. MPV of C multiplied by the small c. MPV of D multiplied by small d up to F. So if I haven't got any cash flow problem, I would have wanted to do the whole of those projects in order to get more bigger MPV. But the question is, do I have enough money to do all that? So if I've got enough money to do all that, small a will represent 100% proportion. Up to F will represent all, and I will enjoy the whole of the MPV. But unfortunately, you might not have that money. Therefore, what is your constraint? That is why we said, let's define our constraint. Let's define our constraint as the the third point, and this is your constraint. What is the constraint? Let me take you back. The constraint is the lack of money. Z, okay, Z is representing the maximum MPV that you get. That is the objective function. We are just representing it, but you can represent it by anything. The Z is total MPV that you get as a result of doing whichever combination of the project that you get. Okay, you can represent it with anything. Our objective is to maximize the MPV, so the Z will give you the maximum MPV that you get if you have to do these proportions. Okay, so it's basically like you can represent it with any letter. Now let's go back to the constraints. Our time is up here. Let's go back to the constraints here. What is the constraint? Year 0, the maximum amount you can spend is 50,000. Year 1, the maximum amount you can spend is 12,500. If I decide to do project A up to F, these are the monies I need for year 0. So whatever I have to spend on A up to F, when I sum them up, it should be equals to 50,000 in year 0. Whatever I have to spend on A up to F in year 1, when I spend them, it should be equals to the 12,500 or less, because you can't spend more. So that's what we're going to do. So I will say 25A, 25B plus 12.5C up through should be less or equal to the 50,000 available. The 50,000 available. So that is what they're doing as the constraint. So if you are with me with the question, we're saying 25 small a, because if I do 100% of project A, I have to incur 25. If I do 3% of project A, I have to incur 3% of the 25. So it's the proportions you would have to multiply by. You do the same 25 for B, 12.5 for C, D is 0, so D 0, then 50 for E plus what? 20 for F. Whatever monies you spend on the project should be less or equal to the capital of the 50,000 that you have. These are the equations that you solve, and that's it. Okay, then go to year 1. If you go to year 1, the total cash flows we need should not be more than what we have available, which is 12,500. But be with me, point of attention, be with me. If you come to year 1, I have to spend money on A. I have to spend money on A. B, but C brings in money. D brings, E brings in money. What is it telling you? I have got 12,500 available. Should I do C? C will bring in 5. And E will bring in 25. What is it telling me? The total monies I will have in year 1 will be whatever I will have already plus whatever inflows the project will bring. So if it is outflow, the total of your outflow should be less or equal to the total of your inflow. So in years where there's a cash inflow, you need to add it to the constraint that you have. So that is what they are doing there for you. Okay, that is what we're doing here for you. So they said in year 1, you see A, 50A, 25B. The C was a cash inflow, so it went to the other side as 5C. The E was a cash inflow, it went to the other side because it's coming in. And then D was outflow, F was outflow. And I also have my 12,500. So monies that will be available to me in year 1 will be that 12,500 plus whatever I will get from the C plus whatever I will get from the E, isn't it? But the other project, I would have to spend money. And whatever I have to spend should be less or equal to the monies that I can receive or I can have. That's it. Then the last one is the non-negative. The non-negative is what they are referring to as the furthermore. You cannot do 100% of one project and go and do negative of another project. That's why we call it the non-negatives. So the whole argument is that the small a up to small e, they should be either equals to 0 or they should be more than 0. But they can't be more than 1 because you can't do more than 100%. So the proportion is anywhere from 0 up to what? 1. We don't have it. So you say, let your 0 be less than A, B, C, D up to F, and all of them should also be less than or equals to what? 1. So this is the argument. Okay, this is all what you do. And you tell the examiner, when those equations are solved, we will be able to get the proportions of A, B, C, D, E up to F, such that when we are able to get, where is the objective function here? When we are able to get the A, we are able to get a small b, C, D, E that we will do. It could be 0, it could be 10%, it could be whatever. When we put them here, we'll be able to get the value that we will get in terms of the NPV. Okay, so we're going to leave it here and then we will pick it from the PV of dividend next week. Okay, unfortunately, because of our time, we haven't been able to flow with it. But the recap here is that make sure you are okay with the free cash flows. Make sure you are okay with the free cash flows and those calculations. They are really, really, really important. Okay, and then start reading the capital rationing. So thank you very much for your time, and any questions that you might have, you can send them through the emails. Okay, so thank you very much for your time, and I'll see you next week.